Moody's downgrades the minor banks. Let's have a look. Hello everyone, Florian.heise here and welcome to another episode of HeiseSays. I thought we'd have a look at this article from Mortgage Business. It's regarding Moody's downgrading the non-major banks due to default risks. Now, yesterday we were all shocked at NAB having a trading halt, their profits down 51%, and that they were raising more capital. Now, the big four, they were to go under. I think the government would do whatever they could to stop that. But what about the little players? What about the little players? Does everyone remember pyramid building society? Perhaps we've got people that are too young to remember when banks collapse. So let's have a look at what Moody has written here. Growing credit quality concerns have prompted ratings agencies Moody's to downgrade the issuer ratings and outlook for several non-major banks. And the whole question, just the power that Moody's has with their ratings, that's just a whole other rabbit hole and topic for another video. Moody's Investors Service has announced changes and reviews to the issuer credit ratings and outlook for Kodos Bank, MyState Bank, Me Bank, and IMB Limited. So let's have a look. To be honest, I wasn't familiar with these banks. I hadn't looked at them in any great detail. So I brought up MyState Bank here. They're a Australian financial group headquartered in Hobart, Tasmania, formed in 2009 following the merger of Tasmanian Perpetual Trust and MyState Financial. So they've got, 400 staff, so they're a reasonable size organization. Got some information here, home loans, personal loans, insurance. So, let me know, guys, if you're in Tasmania, do you bank with them? Do you use them? Now, let's have a look at their share price. You can see here, it's followed the same pattern as many others. In Feb, they were at $6.10, and that's a peak, that's a high from the data that we have. They reached an all-time high of $6.10, plunged down to, what was it? $3.29. So they didn't quite lose 50% and went up to $3.89. So we'll have to see how this ratings change affects these organizations. But this is a similar pattern, isn't it? We're seeing it in all these financial institutions. And they're such a big part of our stock market here in Australia. I mean, what are we? We're a country that mines resources, sends them overseas, then builds houses, and borrows money and sells coffee to each other. Go Australia. So, Codes Bank long-term issuer rating and assessment has been downgraded, with its outlook also revised from stable to negative. Moody's has also placed on review for downgrade all ratings of MyState Bank, while also revising its outlook on Me Bank and IMB Limited from stable to negative. So, what will that do for consumer confidence? Would consumers even be aware of this? Would your broker tell you, oh, don't go to them, they've got their rating at negative? Or is it just the risk that they're facing? What is this telling us? If they're concerned about default risks? We're hearing in the news, we're hearing from the governor that the banks are so good. They're giving these mortgage holidays. They're doing this, they're doing that. But then I'll bring up the Roy Morgan employment figures. Unemployment and underemployment, 2005 to 2020. Wow, 2020. We're so far in the future, guys. Here's the late March figures. 27.4% is the, I think, combined. They need to flip their chart. Yeah, it's unemployed or underemployed right now, late March. Unemployed is at 16.8 and underemployed is at 10.6. 16.8 ABS is saying we're at 5.2. Who do you trust, everyone? The ABS? The Reserve Bank saying that the banks are all good, they're going to be easier on everyone. They can't. We're seeing what's happening at NAB. They can't allow these mortgage holidays to go on forever, can they? And how's that? Are these little guys going to be hit first? Are they going to be hit first? The revisions come just weeks after the ratings agency downgraded its overall outlook for Australia's banks from stable to negative in response to credit quality concerns emerging from the ongoing illness crisis. Now, this is a big deal. I'm looking at ETFs as ways to just generate a passive income rather than investing in one or two particular shares. Because, well, frankly, you diversified. Seems too good to be true in some ways. But I was looking at their, a particular ETF, which was just a, Australian dividend payer, and 45% of that ETF was in the banks. So how much of people's super, how much of people's, private shareholdings is in the banks in this country, guys? Because it's a good, stable dividend. In a way, is our civilization kind of like the American mortgage-backed securities? Are we a mortgage-backed civilization? I don't want to think about that right now, to be honest. That kind of worries me a little bit. Moody's reiterated that it is expecting the economic impact of the illness-related disruptions to strain banks' loan performance and trigger a rise in defaults. Following its decision to downgrade the aforementioned banks, Moody stated that the ratings actions are prompted by this change in outlook on the broader banking system. As a result of weakening economic activity and rising unemployment, Moody's expects loan defaults to increase, although the ultimate impact will depend on the breadth and severity of the disruption, as well as on the effectiveness of the large stimulus measures provided by the Australian government to support domestic companies and consumption. Still no discussion of the potential cultural impact this is going to have. Change in habits. I guess we'll just have to see that. We'll have to see how it happens. Moody's also noted that an increase in credit loss provisioning, record loss interest rates, and strong price competition amid low loan growth would also dent bank profitability. Therefore, Moody said it expects lenders, particularly small banks, to struggle to generate adequate capital buffers against loan losses. Despite funding support from both the Reserve Bank of Australia and the federal government. I was under the impression that they would already have buffers to allow them to weather a storm like this. MyState Bank issued a statement in response to Moody's decision, reassuring shareholders that the bank remains well capitalized. MyState Bank remains compliant with its key regulatory capital and liquidity ratios and has prudently managed these ratios at appropriate levels as the illness pandemic developed. MyState Managing Director and CEO Melos Sulich said, "We will continue to focus on maintaining a strong bank and providing support for our customers as the nation manages its way through these extraordinary times." Moody's announcement comes as several banks, non-banks, and mortgage insurance providers tighten their serviceability criteria for new lending in response to growing credit quality concerns arising from the crisis. So let's have a look at one of those articles that they've mentioned here on lending serviceability. Because while it's from the beginning of the month, I think it's important to have a look at this. Because remember when all the APRA requirements were tightened and they were loosened. The requirements for interest rate hikes. People are at risk of defaulting with a cash rate of 0.25%, everyone. Just think about that. You've got a generation that doesn't know what a recession is, that has got no living memory of it. This is going to be tough. A number of credit providers have revised their lending policies in response to growing economic uncertainty fueled by the ongoing illness crisis. Latrobe Financial and ME Bank are the latest lenders to tighten their credit assessment processes to reduce emerging serviceability risk associated with the economic fallout from the outbreak. Latrobe Financial urged its broker partners to ramp up scrutiny of loan applications from borrowers that are most at risk of encountering serviceability pressure as a result of the current crisis. Latrobe Financial urged its broker partners to ramp up scrutiny of loan. I've already read that. That's why that doubled up. The non-bank made particular reference to applicants employed in the tourism, hospitality, entertainment, recreation, personal transport, personal service, and sporting industries. To date, we've made no formal changes to our credit policy and will continue to consider all applications on their merit, Latrobe told brokers. However, as you can appreciate, in order to make appropriate credit decisions that keep the applicant's best interest at the forefront, we must give due regard to each applicant's present and foreseeable situation. As applicants' situations are currently changing significantly on a daily basis, yeah, that's definitely true. Regrettably and sad for some, this can mean they are no longer in a position to move forward with their pending plans. Latrobe has asked brokers to examine whether a borrower's income position has been or could be affected by the ongoing crisis and whether the applicant has a plan to continue to meet loan repayments in the event of hardship. That's a good point. But this is putting a lot of burden on these brokers. Are they even going to be able to identify that? I mean, we've seen these industries have just been slammed. And I mean, this is the thing, the affordability of these houses, a lot of them is just insane. And in some parts of the country, people are borrowing so much money, even when it is dirt cheap. I'm seeing comments where people are saying the banks need to raise rates to increase their profitability. When's the last time the banks have raised rates without an RBA prompt? I can't. I think I remember it happening, and there was a bit of outrage, but I can't quite put my finger on it. Let me know in the comments if you remember it. The lender noted that acceptable methods of demonstrating preparedness for hardship may include plans to convert to interest only, draw from cash holdings, reduce short-term living expenses, release equity superannuation, or draw on the support payments. Those are all terrible plans. But would you want to do that? I mean, honestly, yeah, you'd rather take your super and pay off your loan, wouldn't you? Me. The member-owned lender has also revised its risk appetite, changing its serviceability criteria to reflect an applicant's field of employment. Why isn't that normal? Can someone explain to me? Wouldn't that be a normal thing you would consider anyway? Okay, I'm not in the industry, but I would assume that you would take their employment into account. But for applicants lodged from Tuesday the 31st of March, so last month, time in job policy, which only requires loan applicants to demonstrate 3 to 6 months of employment, will only apply to nurses, medical health professionals, teachers, IT consultants, and ambulance officers. So there you go, all the people that are essential services. What about military personnel? As a result, ME will require borrowers working in any other profession to demonstrate at least 6 months of employment or 12 months of continuous casual employment in the same field. Changes to ME's loan policies are not taken lightly and reflect the need to adapt to a changing market environment and continue to meet our obligations to responsible lending laws when assessing borrowers' application, the bank told brokers. So there you go, guys. Latrobe Finance and ME joined the likes of Bluestone, Latitude, and Pepper Money in revising their risk appetites. So we're seeing, previously, the beginning of the month, revisions to risk appetites, but Moody's has downgraded a lot of the miners due to default risk. We're seeing unemployment and underemployment at 27.4% if you look at the Roy Morgan data compared to the ABS. And people at risk of not being able to service their loans in an insanely low interest rate environment. What confidence does that give you all for our economy and the recession that we're rapidly in? As always, please let me know your thoughts and opinions in the comments below. Thank you all for watching. If you're a fan of the channel, please like, share, and subscribe. Help the channel grow. You can support us via Patreon or YouTube. You can also use our affiliate links at Amazon or eBay or Independent Reserve and Kucoin. You can buy our merch from HeiseSays, send us gold using Gold Pass, and support us via PayPal. Thanks everyone, have a great day, and I'll see you in the next video. Bye for now.